anyone of you has received the Cytonn reports, the monthly reports? Yes, 25 years. Sorry, I get a lot more credit than I'm usually due. But firstly, thank you everyone for the time. It's difficult for everyone to wake up on a Saturday morning. No one knows where anyone was yesterday night. So the fact that everyone was really busy around the coffee stall, you could tell that some people had late nights. But I think the most important thing is that, look, the ground has been laid in terms of what is it for investments. But forums like this are so important for a number of reasons. They allow us to get education. Sam said it correctly. There's many fools in this market, right? The idea is that you don't want to be one of those fools. You don't want to be that person who makes an irrational investment decision in a rational market, because we've seen it all across the world. And when I go through my slides, you'll see it in private equity as well. That what really happens is that people jump on a speculative bubble, they go around, they keep buying. I mean, we saw it in the Kenyan market about 3 years ago. There was no reason as to why stocks prices should have been rising. They were not supported by any fundamentals. It was just people saying, oh yeah, stocks is the place to be. And what happened? It crashed. I happened to be with Merrill Lynch at a time when global financial crisis was at its worst. And we've seen the pain of irrational investment decisions. So forums like this are important. And for me, ideally, the goal here is just to do investor education, because there's nothing more important than investor education. And it's demystifying investments for everyone. Because you don't have to have 1 million shillings or 2 million shillings or 3 million shillings to be an investor. No. I mean, I'm in private equity and people always say, yeah, but I can't invest there. You know, I'm not there yet. And I tell them, but you're lying to yourself. Right? So go home, take a good look at yourself, and you'll come back and tell me that, yeah, I can actually do this. But the reason is investor education. So we support forums like this, and thank you, Dariju, for actually allowing us to be here and be able to pass on a little bit of what we do every day. So the first question, how many of us are actually investors? Come on, with confidence. Okay, there we go. And you see why I ask with confidence is because finance is a game of confidence. That is it, right? There is nothing else to finance than confidence. And it was said very well. You might think that you have the best investment, and you might have the best investment, but everyone else thinks that, oh my goodness, what the hell are they doing now? Right? And we get it all the time. And we get it from, well, I get it from my CEO as well, like, shit, what are you doing? And if you've not built confidence, you can't undertake any investment. So the first thing is, today, at the end of this, everyone go back home, right? Sit down, ask yourself, I have my monthly salary, or I get some money from dividends, or I have some money in a bond, but what can I do to invest every day? I'm not saying save, I'm saying invest. Put a little bit of money aside every month, every week, whatever you can do, and start investing. Because it's the only way you'll get to learn, it's the only way you'll get to know exactly what is there in the market. I mean, you can read as many newspaper reports as you want, and by the way, those of you who follow like business news from the newspaper, please don't do that. The reporters are the, sorry if there's any reporters over here, I apologize in advance. But look, you're not going to get about newspaper tips from an investment tips from a newspaper that way. So, what is it that Cytonn does? Cytonn's an investment management arm. Though the stocks and bonds bit was very well covered, and I think that's the complementarity of today, is that I can now speak to you about a different asset class, and an asset class which is not understood, and an asset class which is usually shied away from, because people don't understand it. So, first I'll ask a general question. What is private equity? difficult. It's in the name. Anyone? Okay.
Investing in unlisted companies.
Investing in unlisted companies, exactly that. Right? I usually give an example. When today you buy Safaricom or KCB or anyone, it's the management of Safaricom and the management of KCB's job to derive value for you. When you are buying a stock in KCB, you're putting your faith in Joshua Igara and his management team to be able to deliver on their promise, right? Because you've done your model, you've seen it's forecasted, and you like this company, you like the structures they're putting in place. So you go ahead and you buy it because you've got confidence. It's all about confidence in this market. But private equity is slightly different. You're buying unlisted companies, and it's your job to derive value. Now, a lot of people say, yeah, but I've got my own thing going, so I'm not going to be sitting there and buying someone else's company and then going and extracting value. But the thing is that there's so many people, and we try to be that person who actually goes out and looks for investment opportunities in real estate and private equity and allows everyone to participate in them. Because for us, when we look at the market, it's really where we see the returns are. We look at investments, and there's two types of investments, right? Today, if you went out and you said, I want to invest, you'll probably be shown equities and fixed income, which is your stocks, bonds, treasury bills, fixed deposits, unit trusts. Those are what is known as traditional investments, because it's what everyone usually invests in. What's the benefit of them? They're liquid, which means you can buy and sell today if you want, though not very much in the Kenyan market. They're highly sensitive to interest rates, but they're visible, right? Today you can go and see the price of Safaricom on the Nairobi Securities Exchange, right? You know where it's at, what it's trading at, and how many shares I can buy and how many I can sell. Then you have alternative investments. People always say, and we get this when we go out and visit Kenyans in the diaspora as well, and they say, yeah, but you know, I'm buying land. And like, yeah, so I'm an investor. And, no, you're really not an investor. You're buying land with a hope. So you might as well buy Safaricom and pray, because I don't see the difference between you buying land and you just buying a stock and praying. So there's different ways of investing. So alternative investments is largely private equity and real estate. So, we described it very well. What is private equity? It's just investments in unlisted companies, where you go in, you buy a stake, you grow the company, and you end up selling it. The difference is that these sort of investments are high risk, high return, right? And they require investments for a longer period of time, which is why I was really happy that the question was asked, what is a long-term investment? For us, when we're committing to an investment across any sort of asset class, especially in private equity and real estate, we don't go for less than 3 to 5 years. However, those of you who are in investments with stocks and bonds, please don't go with a 3 to 5 year mentality. There's many different investment options for everyone, and I think that's the key to take away, that you can invest in anything, right? But before you do it, please make sure that you have spoken to someone and given your money to someone who understands what they're doing. I always have fights with my analysts at Cytonn, and I ask them, do you know, like, you're going for this, because we have management meetings with companies all the time, where we go and we ask senior management and CEOs, and I'm sure you do the same, as to what is your strategy. And management will always sugarcoat these things for you. Yeah, you know, we're going to be the leading this, and we're going to be the leading that, and then you buy the story, and 1 year later, they're still there. Right? They're still doing the same thing. But they're like us, right? They're employed, they're paid a decent salary, right? Their targets are, you know? Right? No one's under real pressure to deliver. So management's word is not always God-given truth. So even when you read things in the newspaper, like Safaricom is doing this, and Equity Bank is doing that, and KCB is doing this, but you have to really take a step back and then ask yourself that are you really going to do this? And we ask that question sometimes, and then we get told to leave, which is, it's usually not the best thing in the world, being asked to leave, but, if you can't answer a difficult question, then you don't deserve to be running the company, right? It's a very simple way to go about it. So I usually fight with my analysts when I say, do you know enough about this company? Right? Do you really know enough about this company? And forgive me for being crude, but I ask them, do you know how many times the CEO goes to the washroom in a day? Right? Because until the point you can confidently tell me, I think he goes around 3 times, right? You don't know that guy well enough. Right? So if he goes to a club in the morning and he goes to swim, you should know. Right? Has he got family trouble? You should know. Right? What are you hearing about him on social media? You should know. Do you follow him? Yeah. So their results. Okay, fantastic. They did very well. But take a deeper look into their results. Right? Was it just one-time results? Right? Did they achieve results purely because they, a lot of banks these days, they hold assets, land as assets, right? So an interesting example of Standard Chartered a couple of years ago, 2013, they sold a parcel of land for 1.6 billion shillings. And then that year their results were phenomenal. They were up by 1.6 billion shillings. Right? So everyone in the market was jumping and saying, oh my God, look at Standard Chartered, they've done so well, right? But they've not done well in their core business, right? So a deep look at the underlying of the company tells you that, hang on a second, these guys don't really know what they're doing, right? And it's important that you take a detailed analysis. Look, it's your money, right? Everyone here works hard for their money. It's really, really important that you spend time making investment decisions. There's a lot of factors to consider when making investment decisions, and they were very well pointed out. The first is, obviously, your income level. You have to know, deep down in your heart, don't lie to yourself, how much can I put aside, right? Because your friend is putting away 100,000 shillings a month, right? Don't also put away 100,000 shillings a month, right? If you can, well and good. But take a step back and first ask yourself about your circumstances, right? No one faces the same circumstances as anyone else. Right? And then lay down a goal. A goal is the most important thing. So I'll give you my personal example. I am saving for an MBA, right? But here's the trick. I'm not saving. I'm investing for an MBA, right? My other partners are investing for different things, right? Someone might be investing for their kids' education, right? Thank God I don't have children because I don't think I'd be able to do that. But at this point in time, you have to understand what is your investment objective. And once you have a clear idea what your investment objective is, now take a look at yourself and say, okay, how do I get to point B? I'm at point A today. These are my circumstances, this is my age, this is my risk profile, these are my commitments, right? And sit with someone like someone and break it down, right? And be honest to yourself as to what are my investment objectives, because that's the only way you'll get yourself on the path to investment. So, I mean, these are very, I'll just send the presentation and carry on. So, when we look at private equity, what do? We go in and we take stakes in private companies. We put in a lot of money to drive growth. And we partner with their management and we say, look guys, we like this industry, right? We like what you guys are doing. You guys need capital to grow, right? So how do we partner with you, right? And sorry for being a bit technical. When you're investing, it's usually a J curve, right? Can everyone see that? It's usually a J curve. It means in your first few times of investment, you will put money in. And you will just keep putting money in, and you won't be getting any return for that money. Right? Because this is the point at time when you are committing capital. You're saying, okay, I need money for this thing, I need money, so you keep putting in money. Right? Then there will come a point, and for us we usually see it, well, 5 years is a bit bad. Actually, this slide needs to be changed. But usually within 2 to 3 years, you have still sunk in money and you have not got back any return. right? Because the strategies you're trying to put in place in order to grow this company, they take 1 to 2 years to materialize, right? There's some investment options which don't need patience. There's some which need patience, right? We're currently doing real estate deals of 56 billion Kenya shillings, right? There's some land transactions we close within 1 month, right? We know the seller, we do our due diligence, everything comes back, but you guys know Kenya, right? There's times we sit on land parcels for like a year, right? And you just purely can't move. You can't move. Today I cannot go to sleep, right? Knowing I have your money and I'm not sure about the return I'm delivering to you as a client. So it's really, really important. So it's only after a little while, and this is the case with all sort of investment. Know how much loss you can take. But the interesting thing is, normally it's always a paper loss, right? But Sam said something really right. Know when's the right time to sell, right? Don't sell because everyone else is selling. Right? When you, and I'll add everyone who's not on our mailing list, but for us, when we cover stocks, we have a target price, right? So if KCB target price is at 60 shillings, when it reaches 60 shillings, we sell. We sell, right? If the market goes to 80, good for those who still have it. Really good for you, right? But when it's time for you to sell, exit. I'll give you an example of Cytonn, right? And Cytonn's a company we have a lot of respect for. Because what do? They actively manage their investments, right? No matter who you are as an investor, it's important that you actively manage your investment, right? When they were in UAP Old Mutual, right? Only 2 years, they saw an opportunity to sell, out, right? Let's go, move on to the next thing, right? And that's how investment should be, because change is inevitable, right? Those who resist change, right? You will just be left like everyone else, buying land, right? Let's go to the next one. Next. So, when you're doing an investment, and I know this is largely for private equity, but it applies to any sort of investment which you do, right? We say there's 5 phases to investments. The first is sourcing or pre-screening the investment. Okay, so let me put myself in a position where I want to buy stocks in this market, right? So I'll first take a step back on my pre-screening and say, so GDP growth, 5 to 6%, interest rates, well, they should be going up, not sure, currency, depreciation. So when we take all those factors into account, which companies or which sectors should we be looking at, right? And you'll usually come up with financial services. You won't touch manufacturing at all, even with a stick. Sorry for those of you who are in manufacturing. Right? But you always do some sort of a pre-screen, right? So just take a wide look at the economy, and if you've actually taken time to think, you're already on the right path. Number 2, assessment and evaluation, right? It's important to take a step and now do thorough assessment of that stock. Right? How is it performed? How does it rank according to its peers? Right? Like we can take 2 banks today. You can take Diamond Trust Bank and you can take National Bank. Right? Again, by the way, I have a caveat, right? If anyone works for any company I state, I'm not held liable. So, with Diamond Trust Bank, right, or National Bank, one could be more profitable, right, with the same number of deposits than another bank, right? Today, if INM Bank got 1,000 shillings of deposits, they might turn it into 10 shillings, right? National Bank might turn it into 6 shillings, right? It's important to take that step and look that for every extra deposit which they get, how much more can they generate, right? Because that now starts to give you an idea about management, right? So now you know, this management seems to know what they're doing. And one thing which is not said and should always be considered, management is the most important thing in this world, right? Please, even if you are buying a listed stock, the first thing you should look at is quality of management. I mean, unfortunately, we saw it with the Imperial Bank saga. You don't want CEOs who have been around for 20 years, right? You don't want them. Our CEO, Edwin, tells us, you know, by the time the board tells me it's time to leave, I'm happy to leave. Right? Because by the time someone has been a CEO of a company for 20 to 25 years, right, he's resistant to change. Right? They're resistant to change. They're not interested in what's happening in the world. They're not interested in making investment, in making strategic decisions anymore because the guy's comfortable now. Right? Now he's only thinking, so now I need holidays, I need to go with my wife here, and there's other nasty reports which come out, but like, anyway, right? So first thing to look at is management, because that's the people who drive strategies in companies. Next, you structure it, right? You look at, okay, in this case as an investor, how much can I put aside in this stock, right? Next, monitor and engage. Please, when you make an investment, right, even if it's through a broker, an investment manager, no matter who it is, right, know where your money is and monitor it yourself. It will help you sleep at night as well, and it will help you ask the right questions. If you don't ask the right questions, you're in the wrong thing. If you don't understand something, please don't put your money there. Really, please don't. It's very, very important that everyone understands where they are, because it's the most important thing. And then exit. Know when it's time to realize. The Sprycom example was great, because if you've made 60% in 3 days, leave. Go away. Right? Take your money, go on holiday. Like honestly, you're staying there, you're going to burn yourself. Right? We call it in investments, you burn your fingers. Right? And whoever is an investment manager like myself and will stand here and tell you they've never lost money, they're the world's biggest liar. Right? Everyone loses money. Right? At the start of the year, I thought this market would do 10%. I'm not lying. Right? I even put it in my report. Right? I'm standing here today, I tell you, man, right? I'm down. Right? Really badly though. Right? But you know that it will recover. Because markets are like that. Markets are like that. You have to know when's the right time to exit, and you have to be patient. Right? If you jump on a bandwagon when it's time to buy and it's time to sell, that's it. You've burnt your fingers. Next. Okay, so now, what's the type of private equity funding? People always come up to us and say, how did you guys start Cytonn? And Cytonn, as much as it's a story of financial services, it's a story of entrepreneurship. We didn't have a very good publicized exit, everyone knows that. At the same time, people always say, but you know, I'm an entrepreneur and I've got this great idea, but I don't have money to fund it. Right? You know what we always tell people? Right? The only way you will get money for your idea is if you commit something yourself. Right? Commit something yourself. Show me, right? Show me that even if you don't have actual money, you have put your blood, your sweat, your tears, your time, sleepless nights into this idea, right? Because that's the only way you will then get additional funding. I mean, if we were to all fund ideas, right, this country would be finished by now. The beauty about Kenya, which no one else realizes, we always complain that interest rates are so high. Right? Interest rates are at 18%, they're at 20%, and we never really know, like, oh my goodness, are we ever even going to be able to buy anything in this market? Right? But the beauty is that we're still doing 7%, 6 to 7% GDP growth with interest rates at 20%. It only means one thing. It means that this market is not driven by speculation. Right? Markets that are driven by speculation then have a lot of debt. Right? Because people borrow to fund their idea. Right? Today you might have a great idea, but are you willing to borrow at 20% to fund that idea? Probably not, right? You're like, shit, but what if this thing fails? Right? But like, it's the truth of the matter. So when we look at private equity, and I'll give you Cytonn's example, is how do we start? First, angel funding. That's the first step towards funding your idea. It's friends and family. For us, whatever money we had made, whatever little we had invested, whatever pension money we had, we broke everything and put it into Cytonn. Everything. Right? There was no plan B. Right? This is everything we have, everything goes in there. Then you start working. You start building your idea. You start telling people why is it that they should trust you. Why is it that it's important for you to be able to take their money and give them a return. Right? Because at the end of the day, today you give me your money, I'm promising you a return. Right? You go to sleep, I probably won't. Right? Then it's important that people have to take that idea and make it work. Then there's venture capital. People always say, well, for those of you who don't know what venture capital is, it's the money that comes in right after the idea. There's a lot of people who say, well, you've got this idea, you've made it work a little bit, right? So here's some extra money to go along. Then third is growth capital. This is where we come in. And we say, you've got an idea, it's tried and tested, you've got a little bit of money, you've made that money work, now you need money to really grow, right? And you need management expertise, and you need us to be able to guide you. Then the last is you go public, right? If there's a single, well, there's a lot of private companies who tell you that, well, you know, we don't have any ambition of going public, which is fine. Everyone is content with where they are, right? With Cytonn, we've set ourselves a goal. If we're not public by 2019, we're failed, right? So everyone has that sort of an idea. So here I want to come to investor psychology and explain to you how it's caused 4 financial crises, right? Nothing else but investor psychology, right? And people jumping on the bandwagon, right, has caused investor crisis. The first was in 1980s, right? I was not born then, but I have read about it. Right? The first financial crisis in this world was leveraged buyouts in 1980. Right? What happened? Interest rates were cheap in the United States, they were cheap in Europe, so anyone who wanted some money could go to a bank, right? Take money out at 0%, right? And continue on this enormous growth. Right? The difference was that there was no fundamentals driving the market, which means people were not really spending, people were not really investing, people didn't really like the products that were coming out into the market. So after a while, there's only so much hype you can sell, right? Because, I mean, after that, it's all downhill, right? It's like a little balloon, it goes up, bang, right? Everything comes back down to earth. That's what happened. That's when private equity first came into this world. It was through a gentleman by the name of Michael Milken. He said, well, all these companies have collapsed. Some of them have good ideas though, right? So let's start acquiring them, put in place proper governance, proper management, proper structures, and we'll grow them. But what happened? Everyone, right, wanted to go and borrow to fund their idea. It caused a global crisis. Next, savings and loans crisis in 1990. Again, similar thing, interest rates were low. Everyone wanted, everyone had a little bit of savings. They would put it in a bank and take out huge loans on their savings, almost 50 times. I've got 2,000 shillings in a bank, I got 100,000 shillings loan, right? And then you ask yourself, like, man, those people were stupid, right? But the thing is that everyone was doing it. Everyone was doing it, right? So then there obviously comes a point when you're at the top now and you realize, oh shit, my salary can't pay this thing, right? The only difference is it's not you only who's realizing, right? There's a million other people who realize the same thing, right? And boom, market went again. What happened? Everyone was jumping on the bandwagon. Then 2000s, this time thankfully I was born, right? The post-dot-com collapse. Right? This was one of the greatest times in financial services ever. Right? It was when everyone realized the value of technology. Right? But what really happened? Every day in the United States, 50 technology companies were going public. Right? 50. We have 50 listed companies in Kenya today. Right? Over how many years, I don't even know. Right? Every day, 50 were going public. Right? It no reason for them to go public. There was absolutely no reason. Right? They were just going public because everyone was going public. My friend's got a tech company, is going public, even me. Right? So what happened? Market is not driven by fundamentals. People don't really like the technology. Everyone is just going public. Boom, again. Right? Then the most recent one, and everyone is still, Europe is still suffering from it. Right? The credit crunch. It was all down to the housing market. Again, people said, I've got a little bit of money, right? But I'm sitting on this nice house, right? I can go and mortgage out my house, right, for 1%. So if my house is worth 30 million shillings in the US, whatever that is, $300,000, right? I can go and take a mortgage out on this house for an extra $300,000, right? So people kept taking out loans on their houses, So what happened? There was some people who had 4 loans on one house, right? So they're taken out a 120 million shilling loan on a 30 million shilling house, right? With the hope that house prices would keep increasing, right? Again, hope. Guys, hope is good, right? And we all hope for better things, right? That's where it should end, right? Hope is great, right? I mean, I hope for nice things, right? And everyone does, right? But be rational when you're hoping as well, right? Everyone here is religious as well, right? Yeah? It's important that you have faith, right? Because it brings you back down to earth a little bit as well sometimes, right? It's really, really important. So what happened? Everyone was borrowing, house prices went the other way, right? No one saw it happen, market crashed. Because today, what your house was previously worth 30 million before is now worth 15 million. Your loan, which was 120, is now 150. So everything has gone the other way. And that's it. That's how 4 financial crises were caused purely by people jumping on the bandwagon. Right? So people always ask us, what do you do? So I say, look, we're investment managers. It's a professional practice, and I'll be vouched for here. Today, when you're sick, right, you go to a doctor who you know, right? You won't go to just any doctor, right? Because you're like, this guy's a shrink, right? He's going to prescribe me some. He'll write you medication, and you leave there smiling, saying, thank you, thank you, thank you. You throw that thing in the bin, right? Today, when you have a lawsuit, you'll go to a lawyer who you know, right? Today, when you want any sort of professional service, you'll go to someone who you know who's a professional, right? It's the same with investment management. When we're dealing with people's money, right, it's important that we first build their confidence, because it's a professional practice. You want to go to people to manage your money who you are confident about. Comes back to my thing. Finance is always a game of confidence. So what do? We take money from people who have funds to invest and want a good return, and put them into investment opportunities to earn a return. It's very simple, right? We just take money, put it here, get the return, give the return back to you. That's our job. But it's more than that. What do we want to do? We want to create and grow wealth for clients. It's important. Any investment manager today wants to grow wealth for their clients. You want to fund great ideas in companies by allocating them funds. And here's the other side, which people don't like to hear. You also want to kill bad ideas, right? By not giving them money. Right? I mean, you guys are all following this Uber thing, right? In Kenya, and it's ridiculous, right? I mean, why? Why are we fighting them, right? Change is inevitable, right? It's not a bad idea. We should not kill it, right? I'm sure everyone has seen that thing. It circulates on WhatsApp quite a bit. The world's greatest and biggest hotel company has no hotel rooms, right? Airbnb, right? Similar, Uber, right, owns no taxis, right? It's just providing a service. It's making your life easy for you, right? So let's not kill bad ideas. Next is deliver attractive returns and great lucrative careers, hopefully, I think, right? And you want to improve the standards of living. actually, the next slide is more important. Right? Let's look at all of these companies today. Right? Everyone has seen these companies, right? Is there anyone here who hasn't seen one of these companies? Right? Sorry. Can you guys all see them? Right? Everyone here goes to Java, right? Everyone banks with Equity Bank. Everyone knows Family Bank, right? What is common about these brands? What is common? I mean, obviously one, Arora makes tea, ARM makes cement, Continental is a reinsurance group, HF gives mortgages, I&M Bank gives loans, Mimosa Pharmacy gives Panadol, and Java gives you coffee, right? But what is common about these brands? Anyone? You already answered the question.
They'll be
Behind you.
propelled by
Is it service company?
Sorry?
Service?
No.
they'll be propelled by venture capitalists, private equities.
Exactly. There's not a single one of these brands who has not had private equity investment in them. Not a single one. Right? I mean, Cytonn itself has got private equity investors who have invested in us. Right? Because when we reached our limits of our savings and we needed more money, we had to go and raise money. Right? There's not a single one of these brands that has not received private equity money. But what's the beauty about these brands? Right? Is that they are now stable, well-governed, and organizations which are doing good beyond just making profit. Right? Which is very, very important. For us, our investment objective doesn't stop at delivering returns. Right? We'll give you an example. When we are raising money ourselves from global investors for different deals which we do in real estate and private equity, they want to know, you as Shiv, how much money are you yourself committing to this thing, right? We don't care if you go and take a loan, right? We don't care if you ask your parents for money. We don't care how you get that money. How much are you committing yourself? Because they want to know, right? If you make a bad investment decision and lose other people's money, right? You have suffered more than them, right? It's very, very important, right? Don't ever give money to someone who has not put their own money in that thing themselves, right? Because they are not feeling your pain. And they will not, they'll sleep, right? It's not my money, right? It's very easy to say, but it's not mine, right? But it's very important to have people who are aligned. All of these companies put their own money in there first before they got other money. And now look at them today, where they are. Next. Okay. Global growth, right? Why are we in the most beautiful country in the world? I mean, not the holiday side, right? And the great restaurants. But why are we here? This map really explains everything very well. Look all around Africa other than Asia, right? And you can see Latin America, growth less than 0. US, between 1 and 2. Europe, in the red, completely, below 0. Right? Then Asia, Asian story has been oversold. Right? Everyone is in Asia. Right? And they're doing very well, but they're doing very well in their own market. Right? I mean, like, someplace like India has 1.2 billion people, right? They don't even need to sell outside. They just create a product for 1.2 billion people, right? They don't have to worry about exports. Right? China, the same thing. Right? They got billions of people. Right? They don't care about whether or not someone outside buys their product. Right? Then we look at Africa, right? Because that's where we're remaining in. Right? South Africa is not Africa. Right? Right? We rule it out. Okay? Then you look at North Africa, right? Unfortunately, they've been caught up in a lot of political tension, right? That leaves you with Sub-Saharan Africa. Sub-Saharan Africa is probably the most attractive investment destination in the world, right? But let's split it, right? Let's look at West and let's look at East, right? West Africa is very commodity dependent, right? It's all on oil, gold, copper, titanium, right? And when China shut down, the rest of the world shut down as well, right? I'm sure everyone has seen the stories, right? Because they were the biggest importers of raw materials and diamonds and gold and oil, right? So West Africa has shut down. That leaves us with East Africa, right? When you look at East Africa, you talk about Kenya, Tanzania, Uganda, Rwanda, right? Where are people going to come to if they want to access East Africa? It's Kenya, right? So I always tell people, right? You are lucky, right? And we are all lucky to have been born and can invest in this great area. Because Kenya is the hub of innovation in the region, right? It's the hub of trade in the region, right? We're the most advanced politically, right? We have the greatest absorption of technology in this market. We have the greatest access to financial services anywhere in the world. Anywhere in the world. There's nowhere in the world you can go, right? And you find a service like M-Pesa, right? And nowhere, right? You've got to go to an ATM and you've got to walk like 20 minutes and, you know, it's a pain. There's nowhere in the world you can go and you can access a service like M-Pesa. So when people say, where are you investing, right? Don't let them sell you any other story, right? Invest in, invest home, right? Because this is really where the returns are, right? So where are the opportunities in this market? In Kenya, if you look at listed cap to GDP, market cap to GDP, it's only at 49%, right? It means that there's no opportunities in the listed markets, right? We only have 50 listed companies, right? You can make good investment decisions by putting money there, but it's not your best bet. Then, alternative investments. The maximum allowed in Kenya is 35%, and this is only for pension funds, right? But we're only at 6%. So again, there's opportunity there. Where is returns? You can see in stocks and real estate, right? Over the last 5 years, right? And a per annum return over the last 5 years, you can see that return has been good. It's been about 18% and 24%, right? So if you're taking a good view, right, and you're in the right stocks and in stocks you believe, there's nothing wrong in taking a 5-year view. Don't take a 5-year view on one stock though, right? Don't say, oh, I'm in this thing because you bought it 5 years ago. Right? Anyway, next. And then where are the opportunities, right, in Kenya? I say urbanization, growth of the middle class, demographic trends like rural-urban migration, financial penetration and improved regulation are really, really driving growth in this market. So, last slide. What does it take to succeed in investments? It's very, very clear. The first is you need a crystal clear strategy, right? You have to know exactly why you're investing, where you're investing, and for what you are investing, right? Before you have a crystal clear strategy, don't invest. Next, you need a strong team, right, who is investing for you, right? You want people who are client-focused, right? Who wake up every day and they only think about their client. Then, you want people who are entrepreneurial, hungry, and understand a nimble culture. Markets are dynamic. They don't wait for you, right? You can have been lazy and the boat will have sailed a long time ago, right? Work on execution. Be relentless and focus on getting things done, right? Because if you don't focus on getting things done, you will just sit while everyone else is doing it. Be aggressive with your risk management. Don't be aggressive with your spending money and investing. Be aggressive with your risk management, right? It's very, very important because it will put you off investments if you lose money the first time, right? Everyone will say, yeah, you know, but I tried to invest that time, then I lost, now I don't know, right? Then be innovative, right? What is the easier, cheaper, and quicker way to do the same thing, right? Always think outside the box. I like that we started with an innovative icebreaker, right? Because it gets people to think outside the box. Yeah. And that's it. I really hope everyone has learned a little something. Thanks.